saying. Mark Todd joining us from FIIG right now. Mark, the taper shelter, Bob Byers hiding under it. What is it? Where is it?
The taper shelter is essentially in the 3 to 5 year part of the curve, and that's where most of the demand will be, and will continue to be until we actually see the start of the taper. So the investment thesis at the moment is that you'll be less adversely affected in the event they can't manage taper with an increase in interest rates. They want to do taper with a contraction in interest rates. If they don't succeed that, you'll be less adversely affected if you're in the front end of the curve. At the very front of the curve, you get very little return, whereas we talked about yesterday, 5 years at 134, cash rates at a quarter of a basis point. You have some pretty strong cases for the carry trade in that respect, and so what it'll mean is that you'll run closer to, every day you reduce your duration, that you're getting closer to maturity, and the longer they wait for taper, the better your performance will be.
Right. Okay, that's good explanation. So, I mean, if you're looking at that 30-year mortgage, the yield, 30-year mortgage space, given we've been seeing so much on the housing, what level is it at now, and compared as opposed to those sort of 30-year treasuries? So
the mortgage rate's at about 430 on average, about 429, 430. It's in around those numbers, and that's up from about 330 a year ago, and that's probably the more relevant point at the moment. It's what's happening in the United States is, if you can think of the United States as not being like Australia in that it is not dominated by 4 banks, it has a much more diverse banking sector. It has a lot of regional banks. It is an array of different organisations that provide funding in the form of mortgages. And those banks are suffering from the fact there's a lack of refinance going on. When rates are going lower, in the US you can refinance your mortgage rates at no real cost. No, you just take the lower rate and you fill out the forms and do it. You do pay a fee to do that. It's $1,000. And so that's become great income for the regional banks, and it's been, that churn gives opportunities to sell other products and so on and so forth. And what's happened is, as the rates go higher, the consumer's gone back into their shell a little bit. There's not the same sort of refinance, even though the rate is still low by our estimations. Here in Australia, that's a really low rate. It's just the effect it's having on the consumer is one of continuing to make them more cautious.
And in terms, because that was something the Fed was worried about, wasn't it, earlier, that rise in the mortgage rates, though? But hasn't it come back a little from those levels that it was
Just
at?
a little. I mean, it's still up 1%. The Fed was very quick to get to the point where it said, it's really started in June of this year. That's when it's happened, and it's been quite fierce, the sell-off. And so the Fed was really concerned about how that will play out in the construction sector. And the data point the Fed always points to is, for 7 years, from the start of the GFC, to 7 years, construction added nothing to GDP. And that's an enormous data point for them to say that the economy did not expand from construction at all. And they're trying to resolve that by buying the treasuries, the RMBS, the mortgage-backed securities, trying to push those rates lower and forcing rates lower for the consumer to be able to do work in their homes and get construction moving.
Now, just another area, another sort of asset as well that we're looking at, aside from treasuries, of course, is the muni bonds, municipal bonds. And I mean, in terms of, we saw that Detroit bankruptcy earlier this year, July. There's a key ruling weighted on that as well coming up soon. But what's happening in that muni market since then? So
the muni market is a story all on its own, in that it's a $3.7 trillion mortgage market. And for the 4th year, and which is it's the first time since 1945, that market has continued to contract. So in other words, California doesn't issue as many bonds. All the municipalities are not issuing debt, and there's a couple of reasons for that. Because the debt level is so low, you'd think that they would therefore go and do that, and they would then be able to deal with the infrastructure problems they've got. They've chosen not to do that because they're concerned that, as a liability, that's one thing, it's nice and cheap, but the asset they're getting, which is in the form of tax receipts, is still very weak. And a lot of these, the fiscal problems that the United States has is based around this idea that towns and municipalities have to pay for infrastructure, whether it be in the form of police, road buildings, garbage, that sort of stuff. And if it's built on sales and there's no sales, it's very hard to get the tax receipts and then pay for that work. So Bill Gross made a good point in his recent articles. He was talking about the lack of infrastructure spending in the United States, not just the federal but at the local level, and so the country itself is starting to creak, and it's not getting enough money spent on creating the sort of superhighways that they need or updating their highways, and it's becoming a real problem for the United States to be competitive if they don't spend on their infrastructure, which obviously, you know, take out the United States, put Australia, and you've got the same sort of, you know, issues.
Yeah, absolutely. That's all great. What does it all mean for Australian investors, though?
Well, part of the themes that we're starting to see is the fact that invest short end. So for us, it's the 3 to 5 year part of the curve. That looks like it's an attractive option. We think if global rates will be low for a long time, which seems to be the theme that everyone's now starting to agree upon, if you can get something in those, you know, low sixes and cash rate at 2.5 with pressure going down, it'll be a good, attractive investment. It should be. There are no guarantees on these things, but it should be able to run down the curve and what most of the institutional investors are doing. But bear in mind the fact that it seems to be the attitude for the issuers, whether it be munis and in the taper world, is they might actually just come out of the market and not issue as many bonds. And so you'll have scarcity in fixed income assets. And that creates a different investor appetite. If you can imagine, you say this is a good return and I'm not going to turn that over, no churn, they'll rally quite hard just through scarcity, and there's a lack of bonds around.
Mark, always great to get your insights. Thank you for that.
Take care.
Mark Todd there from FIIG Securities.